Hello everyone. We're going to work through a couple of examples of perhaps one of the more confusing concepts in chapter 3, and that is Social Security and how that affects taxable income. So I've got two examples here that I want to talk our way through to make sure that we kind of understand how this works. So we have taxpayer 1, single, age 70, pension income, some dividends, some tax exempt interest. We won't worry about whether these are qualified dividends or not because it won't matter for our calculations. And our Social Security benefits total. So in calculating how much Social Security is included in income, you need to calculate provisional income or adjusted gross, modified adjusted gross income, which means in this case you're going to add in the tax exempt interest. So normally that would not be included in income because it is tax exempt. Municipal interest from city or state governments or school districts, things like that. So, but for provisional income, we're going to include that, and we're going to include only half of the Social Security benefits for our initial calculation. So that's what's here in provisional income is each of these plus half the Social Security benefits. Now there's two thresholds for someone that is filing single. First one is 25,000, the second one is 34,000. So we look at that and we know we're over the first threshold, and so that's the one that matters. But we have not reached the second threshold, so that one we can ignore for now. Our threshold then is 25,000, so we're over the threshold of $7,300 over that threshold. So basically the idea, the thresholds, the first threshold, anything, if your Social Security benefits don't put you over that threshold, none of your Social Security benefits are taxable. If you're in between those thresholds, then it could be as much as 50% of your Social Security benefits. If you're over the second threshold, it could be as much as 85% of your Social Security benefits. So that's kind of how those thresholds work. So we're over the threshold 7,300. We did not reach the second one. And so we calculate the lesser of half of our Social Security benefits, or 50% of the amount over the threshold. Half, 50%, whatever you prefer, over the amount of the threshold, whichever is lowest. So if I look at this roughly in my head, Social Security benefits for 15,000, so half of that would be 7,800, and so obviously in this comparison, 50% of the amount over the threshold is lower, and that's what I calculate and include in my income. So when I go to calculate adjusted gross income, I'm going to use the pension, use the dividends. I'm not going to use a tax exempt interest now because it is, as we mentioned earlier, tax exempt. It was only part of the provisional income calculation. Then I use the amount of Social Security benefits I calculated that are included. Okay, so not the whole amount, just the $3,650. So our AGI is $16,850. Standard deduction, the $12,200 plus the extra, easy to forget, for being over 65, it's $13,850. So when we talk about itemized deductions, you would always use the higher of the standard deduction or itemized. So for this individual with the extra standard deduction, they would have to have itemized deduction of more than $13,850 before you would be looking to itemize their deductions and put that on the return. So taxable income after subtracting standard deduction is $3,000. So it would be calculating the tax on that we might have to decide whether these are dividends are qualified or not, but that's for a later chapter. Okay, taxpayer 2 and 3, they're married and filing jointly. Both are age 71 in this case, so they're well over 65. So they had some pension income, some tax exempt interest, Social Security benefits are given. So our provisional income again is pension, add in the tax exempt interest, even though it's tax exempt, half of the Social Security benefits. We get provisional income of $49,800. So we're over the second threshold. For married filing jointly, they have two thresholds as well, 32 and 44. We're over the second one this time, so that's the one that matters. So we're over that threshold by $5,800. So if that's the case, if we're past the second threshold and they're married, filing jointly, then the amount of their Social Security benefits can be taxable is included income is up to 85%. But it also it's the lower of the two amounts, either 85% or you add 6,000 plus the 85% of the amount over the threshold. So we're over the threshold by 5,800. We take 85% of that. We add it to 6,000. We get 10,930. 85% of Social Security benefits is 24. So we take the lower, right? That's the 10,930. And that's what we use to calculate adjusted gross income. We go back up, pick up the pension. We pick up this amount of our Social Security. We ignore the tax exempt interest because it is tax exempt. We give the extra standard deduction for each of the two, $1,300, because they're both over 65. So these two would have to have itemized deductions of more than 27,000 to have a better situation by itemizing. So they would use a standard deduction in our case here, 27,000. Then their taxable income would be 16,930. So again, tax exempt interest was used just to calculate provisional income. Provisional income is only used to calculate how much of your Social Security benefit is included in income. It is not used or put anywhere on the return. There is a worksheet that you can fill out that walks you through this process as well. It comes with the instructions to the 1040. But it does not get submitted or sent to the IRS. So that's how Social Security should work out. Again, one of the more complicated, because of the two thresholds and the different percentages, ways of dealing with a tax situation.